Curious, energetic, real estate agents zigzag across a city all day. Between property showings, home inspections, broker meetings, and title company visits, travel patterns become incredibly fragmented. Because tracking dozens of short trips manually is tedious, agents routinely leave thousands of dollars in unclaimed tax deductions on the table. This bar chart compares the reality of the road to the reality of manual tracking. A moderately active agent driving 28,000 miles generates an $18,760 tax deduction. But manual tracking captures only half of those miles, leaving a $9,000 gap in lost value. Trying to fix that gap at the end of the year by cross-referencing calendars and Google Maps is heavily penalized. The IRS requires contemporaneous logs, meaning the record must be created at or near the time the trip actually occurred. Reconstructed logs are considered weak evidence and frequently fail during audits. The solution is a zero-touch automated workflow. By connecting a GPS tracking app directly to Quickbooks via a custom script, you remove human memory from the equation entirely. This automation replaces manual tracking with a passive system that records your business travel as it happens, ensuring the record exists before you even step out of the car. Looking at this QuickBooks interface, the first step is adding a dedicated vehicle expenses mileage row right here in the chart of accounts. Next, we generate an API key from our mileage tracking app. An API key is simply a secure passcode that allows our custom script to reach into the app and safely extract your driving data. We paste that key into a secure coding environment. This script will act as the digital bridge, sitting exactly between your phone's raw GPS hardware and your official accounting ledger. The script's first major function is filtering. It scans the incoming GPS data for a specific date range, isolates only the drives you've tagged as business, and ignores all personal commutes and errands. This visualization shows the script's mathematical core. It takes the total fetched business miles and automatically multiplies them by the standard IRS rate, currently 67 cents, to determine the exact dollar deduction. In milliseconds, this code block translates raw physical movement across a map into compliant, accurately priced financial data. But precise math isn't enough to survive an audit. The IRS demands a specific business purpose for every trip. Slapping a generic label like client meeting onto a 40-mile drive is a guaranteed way to get the deduction disallowed. This data flow solves the documentation gap. It pulls client names and addresses from your calendar, merging them with the raw GPS trip to create a verified log entry. Then it pushes this mathematically accurate trip directly into the new QuickBooks expense account. To maintain quality control, the script features built-in error handling. It intentionally flags any business trip missing a designated purpose, holding it back from the accounting software until you provide the missing detail. By catching incomplete data early, this integration actively prevents the trap of generic logging, shielding you from the most common audit failures. When you initiate the live sync, the entire system fires at once. The automated script processes a full month of driving data in a matter of seconds. And looking closely at this QuickBooks expense ledger, you see the instantaneous result. Dozens of perfectly categorized mileage expenses populating simultaneously, complete with date stamps and highly detailed memos. Zooming in on a single synchronized entry reveals the precision. You have exact categorization, flawless arithmetic, and a calendar-synced memo proving exactly who you met and why. Achieving that level of detail manually takes hours of tedious data entry every month. Through the API, the transfer happens in about 3 seconds. Because the GPS passively logs the small, easily forgotten trips that manual logs miss, the system reaches the 95% capture rate seen in automatic GPS tracking studies. Furthermore, it completely eliminates the threat of IRS penalties tied to reconstructed or inaccurate logs. Mastering this automation reclaims over 40 hours a year and secures an average of $8,000 in additional annual deductions, freeing the professional to focus on closing deals instead of data entry.